Can everybody hear me? Great, great, great. Give me 1 second. Good. Yeah, I'm sorry. I ran a little bit late today. I'm on low volume, huh? Okay. Kelly's a wonderful person. Kelly's a wonderful person. Does a wonderful job. Can you hear me now? Yeah, I could be a half woman. Maybe I ran late too. I don't know. No, eh, ran a little late, so that's okay. Sorry about that. And then when I came in, I had to let the dogs out. All right. So my daughter's asking me to buy her a bulldog. So we stopped and see a bulldog this afternoon in our travels. But that's it. Okay. So welcome everybody. Let's do our disclaimer. There's a substantial risk of loss of trading commodities, future options. Past performance not indicative of future results. The opinions expressed are those of Gary Folk, LTG, LLC, and are not to be taken as recommendation to buy or sell commodity future options for educational purposes only. I'm teaching Richard D. Wyckoff. Okay. So welcome everybody to the class. Again, my apologies for being late. Okay. I'm trying not to be, but I was driving in the car, and you're not. I would have been actually a couple minutes earlier. I should say this, but I drove the wrong way down the. I was not focusing, and I actually drove. When I made a left-hand turn, ended up in the wrong side of the road, on the left side. On the right side, actually, of the road, which should be on the left side. I thought it may have been in England for a minute. But luckily, there's no traffic there, so I had to go into a drive. I had to go to a drive-out. So, okay, look at that. So obviously, with the S&P doing what they're doing, it's something important to talk about. And before I forget, Dan, that I got you. 1 second, Dan P. What day are we doing our one-on-one on? For some reason, I didn't schedule. It's 7, right? Chicago time? Okay. Okay. That's what I thought, because that was the time they had available. Well, okay. Good. Okay. Thank you. Thank you very much. You should get a link for that, okay? I know there was one missing. And there's 3 people that signed up for the one-on-ones last week, and you were the last one. I like the day trade ES in a very short time frame. Okay, there. So you'll get a link to that. Okay, we're going to talk about a 5-minute. We're going to talk about Eileen. We're going to actually talk about that tonight. Don't trade anything less. Don't trade anything less than 5 minutes. Don't trade anything. You must be with VSA type of thing. Please don't trade less than a 5-minute chart. Yeah, don't. Unless you're on a, unless you're on the floor that doesn't exist anymore. Don't trade these 1-minute bars. They're noise. Okay, even up to 5 minutes. And I'm a broker, right? And I do brokerage business. Even though most people trade the platform things, but I highly recommend not to trade on a small time frame. You end up giving your broker money, and you end up not making money. Okay, so it's about making money. I mean, I can't implore. I used to trade the trading floor. Okay, and I can't implore how. I don't know. It's bad, in my opinion. Okay, if you make money, God bless you. I hope you do it, but it's very difficult to do that because you always have to. The best traders in the world are right 30% of the time, 34% of the time. If you're trading on a 1-minute chart, it's too many decisions. It's not really the purpose of the market. Okay, so so we'll see. Okay, you like tick charts? I know. Understand what tick charts. You don't see questions and answers. I'll repeat, T-Row, I'll repeat the questions. I know for some reason you don't see them. They don't show up in this thing. 5 minutes, that should be, yeah, yeah, don't use 1 minute. I mean, if you're using tick charts at that time frame, that's one thing, okay? But please, if you do like the white wave type of thing, it's okay. Okay, let us begin. T-Row, when the questions come up, I will repeat the questions for you, okay? So there won't be a problem with this stuff for you, okay? Welcome new people. I see we have a lot of new people. We're about 10 people short of the most people we had here, but I'm sure we can do that, right? And go from there. Okay. So before we begin, any questions? We have a lot of new people. I usually don't do that, and so any questions, any thoughts, anything? Because I want to get to the stock market first, but I want to do this stuff today. Because I want to do I want to get to the short-term trends. Okay. You raise your intention items? Okay. All right. So we're ready. We are ready to go. Okay. So let's you know what? Let me do the daily first. Let me do the weekly first in S&P. Okay. And don't overnight. I know if a woman chart, somebody is gas in market moves. To show, I told this to people I did the one-on-ones with. When I did the disclaimer, yes sir, did the disclaimer. I will tell you that when those of you that have been trading maybe 10 years or so, when Alan Greenspan did his little book thing, right? And they did the FOMC meetings. People would judge if he had a larger briefcase, he had a lot to say about rates. If it was a small briefcase, he had nothing to say about rates. And so when he had nothing to say about rates, he thought he was going to keep them unchanged. That's how people. Thanks for double checking. That's why it's funky. Okay. So please be careful. Wyckoff wasn't designed really for the short-term quick trading like that stuff. I know that VSA and Gavin they seem to do that, but because I think that do their software type of thing. But I don't recommend trading anything less than a 15-minute time frame. Okay. And I trained before doing that, and I know how difficult it was trading that way. Tick charts. Okay. You're flipping like a spinning top. Okay. So let's start now with this stuff. I'm going to see my screen. Hopefully. Trading has gotten harder over the years. That's correct, because it'll get harder because markets are 24/7. So what goes out as a duck comes out as a chicken the next morning. I used to be able to go home the S&Ps in the evening and open up higher, and if they were in a strong position, make money. Today it closes one way and the other way. It's unbelievable. So it's very difficult. Okay, it's much more difficult today. It's got nothing to do just because there's more globally, right? Okay. So let's start the weekly chart real quickly. Okay, and it's a part by part thing. But here's what's real important, and as you know, when I do the one-on-ones with people, and when I do a lot of these charts that I do for everybody. By the way, there's a special webinar on Tuesday. But when I do these things, you obviously look at trend, but looking at the weekly chart, no real trades, the monthly chart, and I see something interesting. I see an uptrend, but I see these bars, and I see which is anyone's favorite color. Anyone got a favorite color out of all these? Take a color, please. Anyone got a color? First color wins. It's purple. It is. Purple wins. Gotta be quick to be Kim. Gotta be quick to be. Okay. So anyway, we do that, and we'll switch to later. Okay. We'll do each color chart. Anyway, what you see an uptrend, right? And you see a market also these cluster closes with each other. That means the market's basically in equilibrium. That means when these bar charts are trading, one bar. This is why 1 minute charts, something like that, short term doesn't make sense. Okay. Red for second color, then blue. Okay. So what happens is that the market then goes into some type of, after you have mark up or mark down, let's take mark up, okay, you have a situation where the market will form a trading range, okay, and these closes are near each other in proximity. This means that the markets are in balance, okay. Why is it important? Because of one of Wyckoff's principles, effort versus cause and effect. The market needs to build cause. So after the market has moved up, the market has built cause within a particular area. Okay? So what is important about this is that usually when you enter a trade range, when you start to enter a trade range, you get into the situation where you then form the range and you start the left-hand side as it flattens out and you go to the right-hand side. Okay? I'm not going to spend a lot of time on that because we're doing bar reaction. But you see the cluster close over each other. Okay? So that means that there's usually in this area, there's acute news that happens in ACUTE news that happens. In other words, the market has bullish unemployment and bearish non-employment. Okay? So basically, like GDP one day, another the next day. The market goes nowhere, it stays in this range. Okay? Everybody with me so far? So I always look for springs and upthrusts in markets, and this happens to be a nice upthrust on the weekly. If you remember on Friday, the market was about here. Okay? And I wrote in the newsletter that if the market had a steady close, if the market had a steady close or higher, it would be a new high for the all-time highs. Obviously, the market sold off on the low. Okay? Let's put our friend in Mr. Volume. Okay? And the market had lighter volume. So this is an upthrust. An upthrust is a reaction above a previous high and a close under it. Above resistance and back under it. Okay? So, having said that, this is an upthrust possibility in the market. So is this ending action to break hard? Is that a market that looks like stopping action to go lower? In order to have that, you would need to have supply, right? You need to have supply, okay? So this is not a supply bar because the volume is light. The action appears to be, but the volume is too light to be a supply bar. Is this selling? And the answer is absolutely correct, okay? It is selling in the market, okay? It is selling that it's occurring in the market, okay? But it's not supply, okay? There's a difference that way, right? You know that, okay? By the way, Winston, nice to see you here. I know you just got the newsletter and stuff like that, so thank you. So, okay? So, we have a situation where possible. So, what's key to this bar? This key to this bar could be a one-week wonder based upon news because the longs are not getting out of the market, right? If the longs are getting out of the market, you see your value increase. If the market was being, if the funds and specs were buying the market above the highs, you would see the value increase as well. So it's like bees to honey. As the market makes new highs, what happened? As the market made new highs, what happened? There was nobody following the market. The composite operators saw that. We're going to get to the Nasdaq today, John. The market saw that, and the market had a selling off, right? Lack of demand, it sold off. Okay? And we'll go from there. Okay? So this is probably some type of corrective action lower until we get supply. Any question on the chart? Any question on the chart? Did Wyckoff say anything about round numbers like 1900 in the S&P? I think he had a round stomach. No, I don't think so. That's a floor thing that we did. That's something on the floor that every time, if you trade it, when I was in the pit, and everyone said, Ed even, meaning like 19,000. At that time it was like 600, right? Anytime the market would get to an even number, they'd sell like that. But no, Wyckoff doesn't say about that. An upthrust and uptrend may not be a bad thing, right? Because it solves an overbought condition possibly, right? Okay. We don't need necessarily a sign of strength, right? We just need the buying demand to go upside, okay? So now that John triggered my peak a little bit, interest-wise a little bit, so let's go to the daily chart of this stuff, okay? Let me take this off because it takes the lines off. So let's see if we see supply that occurred in the daily chart. Okay? As you know, when the market flattens out, begins the left-hand side, we draw a trading range, and what happens? Okay? So this is a very interesting chart, and I'll show you real briefly why I was bearish, okay? I showed this in the newsletter last week. So those you should have been surprised, okay? So this market is going up on volume. This is decent because the market is going higher. Not a problem. This looks like the market is absorbing the selling here. So markets absorb selling, okay? So the high-end close indicate there's still buyers in the market, right? So what was Friday? What happened on Friday that was significant? Anything? I mean, there's probably outside international as it always is, but what was significant on Friday? We had the unemployment number, right? And was that number bullish or bearish? So the number was bullish, wasn't it? It was bullish. So in the Friday session special webinar that I do, the live trading webinar that we do for clients, okay, I mentioned that it could be very much of a day where the market buys the rumor and sells the fact. Buy the rumor and sells the fact. Okay? Okay? Buys the rumors and sells the fact. Okay? So what happened to be, so this was Thursday, Wednesday, Tuesday, Monday. So every day in the week leading up to the report, the market was higher. Does everyone see that? 4 days there. 1, 2, 3, 4. The 4 days before the report, the market anticipated higher. Right? And guess what? They got what they expected. They got a bullish report. Now, the market didn't necessarily, okay, didn't actually explode to the upside. But when you have a bullish report and the market does not expand to the upside, or you have a bullish report and it's bullish into the report, then it always creates the possibility of what? Of an upthrust. Right? Of an upthrust. Right? So I mentioned that's now when markets top or markets correct, they tend to top from bullish news. Right? They top from bullish news. Okay? That was important. So good economics means the Fed will pull the punch bowl. They will never pull the punch bowl. They will always add liquidity. Right. Markets like a spoiled kid. They want to accommodate the Fed and improve the economy. Yeah, I mean that's what the Fed's job is. The Fed's job is to do that. The Fed's job is to add liquidity and take away liquidity from the market. We don't like it necessarily as far as the amount that they do. Okay, but that's their job. I mean, believe it or not, that's their job. Okay. So, whatever. So it's not good. Or it's good at times, but when they put you on heroin for too long, it's probably not good, right? Okay. So they sold off on the news. So here is the points, right? Here's the point. Okay. The market then Friday had a possible upthrust in volume. So this is potentially some type of sign of weakness in it. Left-hand side, right-hand side. So that would show up. So it would show up on the daily chart before it would show up on the weekly chart, right? Okay. So this is very, very important. This is very important because on the daily chart shows weakness in the trading range. Okay. So what is key here? If you're watching bar behavior, okay, what's key now is that we can get, see, I could teach you in hindsight, but that doesn't really be good in trading. So what the market does one of two things. Either the market can show continuation to the downside, to ice support, have a weak rally back to here, markdown, or have weak demand go sideways. Okay? So those are the three things. If they take it as a one-day event, of bearishness because of selling off, buy the sell the fact type of news type of thing, the market will go up to make new highs within a couple of days or sometime shortly. Okay? If the market has weakness, and this was some type of supply that came in, then the market will either continue down to ice support or trade in a very small range of upside and like volume. Like this. light volume type of retest. Okay? So so that's the case. So you may also form type, you may just stay in the trading range and that's it, okay? Now, those of you that are worried about LPS in the market, right, to jump over the creek and this, not likely, okay, because you don't usually come with supply here, okay? That's just a retest that happened, okay? So that's what you get. So so what you recognize about this market, going into the report, the market was at an all-time high, right? Don't see that? The market was at an all-time high, okay? So because John mentioned it earlier, let's look at the NASDAQ. It's just a clue. And I'm going to show you something that is invaluable, okay? You know the market, I just did market made new high, right? What can you say about the NASDAQ? I'm going to show us a newsletter tonight, by the way, that you actually got yesterday. So I'm not going to the newsletter with, but what would you say about this? Hmm? Markets that take profits in order to pay taxes. I think. I don't know. Gary, just quickly explain the review of the last three scenarios just laid out. Bill, for $49.85, I can't. I will. I will. Very good, Tony. Brian Olson, I'll get back to you tonight, okay? We'll do something tomorrow night, okay? I'll get back to you, Brian, on that. So, this is something even more important than that, okay? Definitely we can S&P, and those of you that do the 101, the more experienced ones should know this. You're seeing selling on the rallies. Those of you that take the thing, and lack of follow-through. You see that? You see the selling of the rallies? Yeah, I was dealing with my dad this week, so that's why. Right? So the NASDAQ is not in a downtrend, but it's short-term. You mean as far as that goes, okay? But here's what's important. Here's what's important about it, okay? I mean, you don't really come into a downtrend until you get down to here, okay? I mean, we're short-term, lower lows and lower highs, but it's not a downtrend, but it's maybe a down channel, I think, more importantly. But okay. So when you see a market that buys the accumulation phase, you see, well, you get accumulation phase in ICE, right? But when you see buyers at lower levels, you see it when they buy lower levels, that's part of accumulation to go higher, right? When they start to sell the breaks, okay, then you get to a situation where instead of buying the rallies, instead of buying the breaks, they are selling the rallies. So when they say that you're selling on rallies, then when you're selling on rallies, that is what they mean, okay? Not one bar necessarily, but it's a series of bars that makes a story, okay? So when you get a situation where they're buying on balance, okay? When they're buying on balance, that's some of accumulation go higher. When they're selling on rallies, they're capping it, that means distribution. Is that clear? We cover this a lot in the 101s, so it's a very important thing. I'm trying to point out to you here, okay? Very important. Okay? Very, very important. So that's why institutions sell rallies and buy breaks. Absolutely correct. That's exactly right. That's their function, right? Isn't that their function to do that? The function is to sell rallies at distribution and to buy breaks. That's true. That's right. John made a good point that they have to sell in the rallies because it's very difficult to sell the breaks because they have to hit the bids. Let me point something out to you. They got some message wise, okay? You know this book this guy wrote about the HFT trading, that these guys taking advantage of that, right? That's been going on since the beginning of time, okay? That is the beginning of time. It does not change. And the floor, when people paid a floor membership, we used to be able to get access before they could do quotes. We got bids and offers in the pit before everybody else did. So that's nothing new that they do. As a matter of fact, it's actually helpful because they add liquidity to the system. Most people don't trade the split milliseconds that they trade, okay? But they actually add liquidity to the market, okay? So it's an electronic thing, so I don't think that it's a problem. I don't think it affects anybody. When they buy on balance, sure. Absolutely, sure. So buying on balance would mean this. They buy 100, they sell 50. They buy 100, they sell 50. They buy 100, they sell 50. That's how the accumulation process works, okay, until they get news. So they bought 300, right, 100, 100, and they sold 50, 50, 150. So they're on balance, they're long 150 contracts, okay? Well, of course they drop, yeah, of course they drop bids, but they do that in the pit too. They've done that in the pit where the famous thing in the pit, well, I'll just do the second for you. When I trade the pit and they trade this email 5 handle tick type of thing, it used to be 20, market would go down from 40, 35, 30. Goldman Sachs would bid for 10,000 contracts at 20. The pit would buy 25 because they knew that they thought that Goldman Sachs was going to buy, 10,000 contracts at 20. So all of a sudden, someone starts selling them the 20 contracts, maybe 50 contracts, and then Goldman Sachs pulls the other 9,500 off. And all of a sudden, those who bought 25s in the market are now selling 10 and 15, 10, 5, and 0, and all of a sudden, they scoop them up, okay? So they pull bids all the time. So I think there's more dishonesty in this electronic trading than it is in the pit trading. Because in the pit, you always had the other side, local in the pit, someone that traded the pit, taking the other side. Electronic-wise, it's not really there. Okay, so they could pull it in a nanosecond. They can pull their orders much quicker in electronic-wise than they could do it anywhere else in there. So orders that are near New York for stocks get better fills. Okay, believe it or not, in the Chicago area, there's a city called Aurora. It hurts the big guys too because they pick you in his pocket. There's a city called Aurora, which is like the next suburb over for me. Okay, they actually have where they have the clearing of the Merc. So people in my area tend to get maybe a nanosecond, a little better fill, supposedly over here. Okay, so. Yeah, so I think the data centers, do matter. But I think for the most part, if you're trying to buy a market, market order, you're going to give up a tick anyhow. So, or you put a price order, you put a price order, it doesn't affect you. But it's the arbitrage that happens between them. So, anyway, let me point that out. Yeah, I know the FBI is probing it. You know what? They can probe every day. There's manipulation in the market every single day. Okay, most of it legal, a lot of it not legal. It's just part of what we do. I mean, if you're right, that's the way it is. So this market's on selling on balance, okay, and it's negative. Now, one of the things I sent every day in the newsletter chart is because it's very important is the fact that I show the NASDAQ S&P spread, okay? I'm not going to go to the spread. It's one subtracted from the other, but you can see that when the S&P was making new highs like late last week, you can see the fact that the market already broken the ice in this chart. And they showed this chart here. So this market actually turned bearish at the end of March when it broke into the ice thing. Okay, so early April when the market broke the ice. So this spread, this is the Nasdaq was weaker, which I showed you. This was the S&P being stronger than the Nasdaq, or the Nasdaq weaker. and this is a very good spread chart that I simulate every day, and it gives you a good indication of market behavior. Okay, so I want to show that to you because this spreads tend to lead, and this is why I send it from the newsletter. Okay, in this case, it was spot on. Okay, so if Eileen is still here, hopefully she is. Okay, let's do this short-term E-mini trading because I think that most of you like that. Well, there. So if Wyckoff is a very good short-term trading, how do you compensate? Darts. I throw darts against the wall. Oh, I didn't say that Wyckoff wasn't good for short-term trading. I said that Wyckoff wasn't necessarily Wyckoff wasn't a 1 minute, 5 minute scalper type of thing. A chart is a chart of charts. So the charts go through the buying climax, selling climax on a 5 minute chart, just the same way they go through on a monthly chart. They go through the same sequence. The difference is the longer the time frame you have, the more surety of trend. The more surety of trend, the most important aspect of markets is trend. Trend is the most important type of behavior you have. Okay? So, trend being what it is, the longer the time frame, the better the trend, the better odds you have of making money. Right? So, I have to compensate for a lot of things, Eileen, and one of them is going to a larger time frame. I got to compensate by being 5'4", 5'5". So I'm trying to step on a step stool. I don't know. I got a height disadvantage. Who knows? Okay. So that's important. So let's get to a 15-minute time frame. Let's go to a 10-minute time frame. How's that? I'll even go to on the lever, and I want to show you this is something I talked about in the one-on-one lecture. Okay, and I want to show I want to show something of a trend type of day. We talked about this in the special webinars. Okay, so those of you that get those and stuff with that. Okay, so I'm gonna do a lot more. I'm doing a special webinar on Tuesday. Okay, so it's out there. Okay. You're 5'3" and has to be 6. Wow, is a foot taller? Gee, you made a tall drink of water. Gee. The air is different for taller people, from as I understand. Okay? So, what happens here, market-wise? What happens here? The market's on the report, so hopefully this is short term, so we're going to go through this, not tedious, but we're going to go through this action pretty well, okay, about trend, about situation, okay? So at 7:30 in the morning, you got the unemployment number, okay? So now I have to switch to red. No, I got to switch to blue, right? No, switch to red, right? Red was the next color. Okay, remember that? So we got to a situation where the market was basically doing nothing overnight, and you'd expect that to happen simply because why? Simply because it was before a report, right? Okay. So the first reaction to the report was what? What would you consider as bar action? Anybody? What would you consider that one bar on the opening, the first initial response? That's the public reacting to the first piece of news that occurs. Okay, so it's up, right? And it's bullish. But what do you see here? Hey, Larry, nice to see you. Nice to see you. So it's not necessarily bullish because we get the close here. So this tells you the market had buying. Yeah, it's market had buying, and then we had some selling. And we had the market selling. Okay? So we doesn't think that's a negative bar because some type of selling and up move could be a probe to go higher. but we see that they're selling in that bar, right? So obviously it's people reacting to the news, right? It's people reacting to the news. Right? Potential stopping action, but let's just take it for what it's worth, okay? We have a market that sold off here. So if we have, does everyone see why this was a selling bar? This is right up by Lindsay Alley, okay? So this is a selling bar, right? And then what do we notice? What do we notice after the 1, 2, 3, 4, 5 bars that retest this? What does that tell you? Now, one bar, now, and this is why 1 minute charts will get the tell your story, Eileen, okay? Because it's a 1 minute chart, you can't tell this bar, a 1 minute chart, what that is. You can't tell this one, you can't tell this one, you can't tell this one, because your edges are here. Those are your edges. There's no edge in the 1 minute chart in this range. Okay? Okay? So it took 1 bar to have stopping action, right? 1 bar had stopping action. And then it took 1, 2, 3, 4, 5 bars to retest that, right? Everyone see that? So after stopping action, okay, I'm going to show you why you have to be smart, okay? The smartness rule, okay? What do you see? What do you see? You see high-end closes. Isn't that bullish? If you look at closes, isn't that bullish? If this market had stayed right here and closed up here, if the market was closed up here and no selling was happening, this would have been a hinge to go higher, this high-end closes. The fact that the market sold off this bar right here, I never really explained this before on Sunday night, okay? Because the market took 1, 2, 3, 4, 5 bars to retest 1 bar, okay, says that even though there were buyers, it was not able to take out when the selling came in. Okay? Now, what's also important is that this was resistance, right? So what do we know when a market has selling and you have this type of behavior? A small range and a slight penetration of highs. What is that? But volumes decreasing on increasing prices. Yes, David, and after selling, that's bearish. Selling the background makes subsequent high-low close suspect, correct. Decreasing volume and shorting a thrust, that's correct. So you're looking for an upthrust. So you're looking for some type of, I'll forget that last sentence, Eileen, okay? It's a lack of demand, okay? If there was no demand, then the market wouldn't go up at all, would it? So it'd be a lack of demand is a better term, okay? There's no demand in any of these bars, right? So you can say no demand, as long as you understand what it is, right? Okay? So what do we have stopping action on a market behavior? We have a shorting of the thrust, or we have an upthrust, right? What do we see? Now, what is important, we trade during the day, and again, I think this is most of the day trade, we talk about this 2 weeks in the one-on-one webinars, by the way. And I mean in the last Tuesday's special webinars, we talked about how to determine how to day trade. Okay, so those of you that may want to get that. Okay, fine. So an upthrust means very little, or short thrust means very little if what? If the market doesn't have selling, does it? This bar tells you that even if you thought this was absorption because the high end close were with the highs, even if you thought absorption, this bar, what I call the kiss of death. Okay, that's not a Wyckoff term, by the way. It's just something that tells me an aha moment, right? Okay, if that market was strong, then that up thrust bar or shorting thrust bar would have led to higher prices. If that market was not strong, thus led to supply, thus led to selling. Why was this a key bar? Anybody? We talked about it a little bit earlier, but why was this a key bar? Anybody? Because it's still above the support. But why was it a key bar? It was widespread, true. Okay. The reason was because anybody who bought the market, anyone who bought the market here are all losers. Losers of money, not losers of people, right? Okay? So, it is a market that if this was buying, which it did mark up, if this was lack of demand, then the market would have been broken, which it did. Okay? So markets are about making money, losing money, right? In this particular case, when the market broke, the market actually had broken down. It told you what this was. If the market had gone higher, obviously it would have shakeout. But what are the odds of this? What are the odds of this being a shakeout? Not very likely. Not with the story in the background. Okay, if it came out of nowhere, that's fine. But the story in the background was a little bit weak. The story in the background was a little bit selling. Weak demand, lack of demand, led by more selling. This happened right on the open of the stock market. So the first inkling by the pit, or when the stock market opened in New York, was to sell the market. Is everyone clear about that? Let's see, you're 100% right. This bar took out the 1, 2, 3, 4, 5 bars previously, right? Just like this one bar took 1, 2, 3, 4, 5 bars to retrace. Okay, market broke. Okay, very good. Okay, now let me show you a little something. Okay, when people, you guys have heard of Elliott wave, right? Type of thing, right? Elliott wave. Well, with Elliott wave type of thing, he does things in 3 and 5 wave boxes, right? 3 and 5 way type of behavior, right? So these were 5 bars up. These were 5 bars up. And the market broke. So maybe 1, 2, 3 bars higher. You know, that's where we get a lot of the stuff by just market general behavior. Okay, it came from basically Wyckoff's work. Okay. So, and he was just looking at price action. That's how Wyckoff did. Okay. Does the selling bar indicate weakness? The selling bar indicates weakness. When you see a bar that has the moment of truth, either, and this is the edge, right? Either it has up or marked down. Either one of those two are happening. When you see that, type of behavior, right? When the market should maybe go higher or maybe should go lower and doesn't, okay? Then it's in your mind, it's always a red flag, right? In your mind, it's always a red flag, right? Well, in this case, when a market was near its highs and does have markup and sells off, it's a red flag for higher prices. That's exactly right. That's exactly right, John. John says a featherweight, as David White says. That's correct. This is this little featherweight that occurs, and the market just has selling pressure. Absolutely correct. Great line. Great line. Okay. Market then breaks, and remember we talked about how the composite operator, Wyckoff's the term. Okay. So the market works down, and look at the volume. the volume increases, correct? The volume increases because all the stops under this low right here got taken out. That's where people put their stops. They got taken out. Now the market attempts to go rally. What happens in a rally? When the market tries to rally, what happens? Small range, decreasing volume. That is your lack of demand. So after selling in the background, you now have a lack of demand bar. Right? You now have a lack of demand bar. Don't you? The lack of demand, right? The next bar happens, a little wider range, and the market has volume that still has lighter volume in the selling market. Okay, right? So far the market's trying to retrace on lighter volume. Right? But the market really can't make a lot of upside progress with volume and demand. It's buying, but it's not demand because the volume's not high enough. Market then is a bar, like this. What happens right here? It's a very significant bar. What's this bar tell you? It's a market that goes lower. It has light volume and closes unchanged, basically. What does it tell you? It tells you, remember I told you that we talked about the CM supporting the market on breaks? Did he? Not with lighter volume in it. It should hit an artery. It did. Chris, I see your question. I'll answer in a minute. Okay? It's the lack of buying. He was a while close steady. But if there was buying from lower levels, the market should have been increasing, right? Not decreasing. It shows you that they killed the demand. And we'll see that. Is that what I'm looking at? If the market was in an uptrend or no selling in the background, it would be bullish. But because you have selling in the background, it's a bearish chart. Okay? So someone has a question, Gary, when you compare range and volume of those two bars, is it not obvious there's no demand? It's obvious to me, yeah. That's why it's a trend day down. That's why we're doing the thing, right? Yeah. When you get selling, you need demand to come in again. And this is all lack of demand in the market. So you're right. So after selling, you have to counter that with demand, right? Otherwise, if you don't counter selling with demand, the market will be sold on rallies. So exactly right. You're exactly right. I see, but since it's not at support, it wouldn't expect to be defended on a dip at the key level. Would you think the dip will draw out supply? Well, don't forget it's intraday chart, John. So yeah, so you should have got demand from here, right? Because this is where the market opened. I mean, this is where the market traded on below the report. So the demand should have came from this area right here, right? So you really may get demand from the area of a vertical bar, right? So there's really no demand that occurred off this area-wise, okay? So the next bar is a bar that retests selling, and the market has a little bit increasing volume, doesn't it? Okay? Not much, a little bit, but the fact that the market tried to go higher was a negative thing, poor close. So what you tend to see on markets that are bearish are these rallies that close poorly. Do you see that? After the upthrust, you see low-end closes, don't you? What does that mean, low and closes? It's a lack of demand, right? It's a lack of demand because demand's got to show up because of the selling in the background. Is that clear? So Gary, how should we look to join the change behavior if the I'm going to explain that to you, Gary, of where your entry points are. Okay? Or where you can't get your entry points, right? Okay. So we then get the selling bar, and the market increases. Well, it's not really a sign of weakness, is it? The market's volume is higher, but still some nice supply that came in, right? Okay. So, after the selling, what do you call this? After the selling bar, what do you call this? That's about as classic a lack of demand after selling I can show you. And we'll see that. Small ranges, low end closes, selling of the rallies. I call these tails. These little tails. Right. You know, somebody asked about why the selling wasn't that, the volume wasn't high here, because the selling already occurred in here. So the market was even when it was down, it didn't have to have a lot of selling to push it down. So, as somebody said, and he beat me to it, as John's very observant, this is a classical, also hinge of the market to go lower. Lack of demand after selling, part of the distribution clause. You see the market goes higher, and it sells off on the close. If those ranges were small and the high-end closes, they would have been what? If they were high-end closes, they would have been lack of demand, because the market can mark up, right? Low-end closes tell you if they're selling and also lack of demand. Doesn't matter what you call it, just identify what direction the market's going to. Market then sells. Now, what we're looking for at entry points is obviously here it was an entry point, right? Because it's a retest of this bar, the rally, right? Okay. Didn't catch this one, you don't catch this one, right? That's why you have to try to catch it early in your face. Market does break, right? You see a market that has increasing volume to the downside. And what happens here? Just a lack of demand bar. Let me say that. So now we have a situation. A high-end bar on a hinge with light volume or even with high volume. If this was high volume and the market goes up here, it would be bearish because the market has a reverse result. If it's light volume, it's lack of demand. If it's high volume and small ranges, it's adverse result. Right? Because the trend of the market is what? Lower highs and lower lows. It needs some type of stopping action in order for you to buy. You don't get that, do you? You don't get that, do you? No. Great, thank you, you're welcome. Okay. You get more markdown, increasing value, market tries to run a light volume, lack of demand, and they hit it again. Then we have to see the reality. What do you say about this? One bar down, 1, 2, 3 bars to rally. What can you say about that rally? Look at the volume. Look at the ranges. Look at the closes. What does it tell you? It's a lack of demand. You do not have a change of behavior and a retest in order to buy that market, do you? You do not. You are not allowed in Wyckoff's world to buy that chart. Just a 10-minute chart. If it was a 1-minute chart people trading, it was a monthly chart. It doesn't matter. You don't buy that market. You have no reason in the world to buy that market. None. Zero. Nada. You need ending action, and you need ending action, and you need a what? Ending action and a retest of the market. Ending action and a retest of the market. Right? Any questions so far? Lack of demand is not the same thing as panic selling. Lack of demand is not panic selling, correct? Lack of demand means that it could be like volume. Right? Panic selling is larger range, larger volume. Yes, the narrow spread high closed with lower volume indicated no demand. When market has selling in the background, the narrow spread high close with light volume indicates no demand, lack of demand, correct? In a downtrend, not an uptrend. Remember, the most important information you have is trend, right? Market continues lower. Increasing volume on the breaks because they're hitting sell stops. Every time you make a new low, the volume picks up because they're hitting sell stops. And the market beat goes on. Okay? You notice this? Lack of demand, boom. Market goes here. Lack of demand, no volume, no demand. Mid-range closes, lack of demand. Lack of demand. There's no demand all day long in these prices. Do you see that? How the gradual erosion happens in the market? How the market just basically falls apart to the downside? How the market behavior is such that it's also very, very weak in the market's behavior such that it doesn't get any buying. And if it does get buying, the next bar is down. Is that clear? Is that clear? Do you need, in addition to ending action, a retest and sign of strength before buying? Absolutely. In a downtrend, you need to sign of strength to say demand is overcoming supply. That's correct. Right? So, as this tells you, what does it mean, the gradual erosion of the market? John just beat me to it. It's just that the buyers in the market are lowering their bids. So the volume is so on light volume lower, when the market goes to this and the volume is light, they're not bidding up prices. That's how markets go up. They let the markets fall, and it's like a feather, right? As the market goes down. Right? It's very bare. The market just erodes because nobody is willing to take a demand. No one is willing to buy the market at lower levels. That's where you get your demand from, right? That's what they do. That the market gets their demand from lower levels. Does that make sense? Very important. That's where Gavin on DSA talks about selling bars and up bars and buying bars and down bars, but he only tells you, it's a BSA principle, but it's not a complete truth in Wyckoff. Okay? We've had 4 to 5% pullback to 18 months before snapback. Any tells you this is different? I don't know. It could be. Yeah, with all the news out there, they can make this market make new highs and break hard too. So I don't know. I never know, right? They don't write me. So, can I explain 8 time selling? Tax time selling. I don't believe that anymore. 2, 3, 4, 5, 6, 7. You talking about this bar right here, Winston? You talking about that bar? Okay. You have no reason to get aggressive by, yeah. What the market tell you? What about this bar? It's a failed spring. It's a market that tries to spring in a downtrend, and we know springs fail in downtrends. So it's just temporary stopping action before it goes lower. That's all it means, right? That's all it means. Springs fail in downtrends. Upthrusts fail in uptrends, meaning fail means going higher, right? That's exactly what you see here. Do you see that? Now, those of you that are trading small time frames and you see this little spring here and you buy them, you have to be very careful because unless you get out very quickly, the market will hit you. So you don't recommend buying springs downtrends. You can, and sometimes you can, okay? But for our program purposes, don't do it. Unless it's the 31st or 30th of the month, and your broker gets paid at the end of the month. Don't do it. That's a joke. Okay? Not stopping action. I mean, stopping action, high volume close. But no, sideways, right? It's the middle of the night, though, too. So, you see what the case wise. You see that in this point. There is no opportunity, none, zero, of getting on the market Wyckoff wise. None. Right? So if you trade, John said it very well. If you trade markets, right? And you trade small time frame, you must be disciplined. You must be disciplined with your stop and trade management of the trade. If you try to buy a spring in a downtrend market because you're trying to take the short-term gyration, you better get out because it's going to make you lose. Okay? Whether you be selling up thrust or shorting a thrust in a negative environment. Buying a spring and buying and shorting a downward thrust in an up environment. That's the Wyckoff wave. That's Wyckoff's work. If you're going to trade short time frame, don't forget, and the reason why trading short time frame, you can mark like this on a 6-minute chart, and a 1-minute chart you can do this, right? So you gotta get disciplined. It's very tough to do that. The trend is always down if you get some type of rally. That's very difficult to do. Okay? Why would they want to be long on Friday? Because they think the market's bullish and they want to buy breaks. We should taught that, right? Where do you start counting the downtrend in this chart? After the ice is broken? I talking about the point and figure chart, Chris? There's two counts that happen, right? One's the count that starts on the creek area resistance on the left-hand side, and then one starts when you break the ice. Right? No, it's a 10-minute chart. When you start your count, well, your count would be, you wouldn't get a count from a bar chart, right? You get a count basically from a point and figure chart. I mean, I figure out stuff on a bar chart that I look at is that, but on a bar chart you don't get cause. That comes from point figure, right? I meant, would you know your downtrend? Oh, would you know your downtrend for the day? When the market takes out this ice support here, and the market begins to make a series of lower highs and lower lows. Once the market hits this bar here, that takes out this ice support, that takes out the report thing, it's bearish. Does it make sense? You have an early appointment tomorrow. Need to sleep. Okay, Elaine. Have a nice evening. Thank you for coming. Okay. So that's it. Okay. So I want to get that before Friday. Okay. So that's a shorting day. So you always look for shorting thrust or not thrust in markets that are bearish. The market can be very, 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 very bullish, and you can have a down day. The market. Thank you, Sam. I appreciate Sam. I'm sorry. Thank you. I'm still here. I'm not going anywhere. I'm just thinking back to Eileen. So, I have one more spot for one-on-one. People probably ask, so but I only have one more spot because there was 3 from last week. So to write me directly, we can talk about that. And if you want the Tuesday presentation, special presentation, just go onto the website. You'll be able to get the information on that thing. Gary, can you show us 60 minutes, 72 hours back? This, I believe, was the story, if not okay. Yeah, of course. 60-minute chart, you know, is my favorite chart. Absolutely. Yeah, the 60-minute chart told you a big story here, right? I didn't talk about it, but yeah. Pen. So Chris asked about when the trend turned down. It turned down for the market here when you got the sign of weakness on the breaking of the ice. Sign of weakness, breaking the ice. You see that, Chris? So when the market shows a sign of weakness on the right-hand side of the market, and it ultimately breaks ice, well, if it's a sign of weakness, just a sign of weakness, determined, that's when the market will start making a trend, right? So it shows you very clearly that the market was in trouble, right? This is an hourly chart. So the problem is that you don't have an entry point. I mean, train left Elvis left the building. You don't have an entry point. That's when the market has claws and is ready to go. That's why it's frustrating sometimes, right? Because even though you can identify to trade it to make money, you know. I mean, it's great to identify this stuff, right? But we have to make money with it. In this case, this chart was very difficult to make money with. Okay? Very difficult. Very, very difficult to make money with. As far as you can go direction, but the thing that worst case scenario, worst case scenario, it's a situation market-wise where the only thing you can do at this point is what? The only thing you can do at this point is get to a point to where what? In which you just try to sell the market-wise, but it's very difficult to do so, right? And I don't recommend doing it. So the bottom line is, as far as this goes, is that the only thing you could do, as far as that goes, is try to catch it luckily, or we don't really trade with luck, right? Or you should do what? Or you should be in a situation where you let the trade go, and you missed the trade because there's no entry point. So now you wait for a trade range, and you look for a shorting of the upward thrust, or, if the market goes up on a lack of demand, looking for an up thrust or a shorting of the thrust, right? What'd you say about Tuesday? Yeah, 2 weeks. We did 2 weeks of how to trade intraday trading. So there's a new topic on Tuesday, right? So those 2 webinars we did on day trading. I think we're doing on stopping action Tuesday. You're welcome. Okay. So let's talk about a little bit about market lack of demand. Okay. It's silver. By the way, if you look at copper, it's a housing thing. So you can see there's copper. You can see how bearish daily copper is, right? That's for housing, so just to let you know. Much copper housing. Silver. Okay. Check it with this cursor. Silver. You can see the market going down. So let me put the volume in for you. So this area, how can you identify it? Anybody? What would you say about the overall thing of silver? Mm-hmm. Well, you have a lack of demand with selling in the background, and the market's making lower lows and lower highs. This is classical trading range including accumulation. This is not accumulation because you don't have any demand in the background. You don't have accumulation, you need to see the demand. You don't have demand yet. Thank you, Larry. Good night. Nice to see you again. So it's probably possible distribution, market behavior-wise, because the market's staying in tough upper range, and that will be bearish to the market. That will be bearish in the market, right? Because the market in a downtrend needs to prove itself, right? If the market does not prove itself in a downtrend, then the market will continue to go lower. The market will continue to go lower. Okay? And if the market continues to go lower, the lack of demand, it will go lower until the CM finds the market lower, finds the demand lower. If it doesn't do it, doesn't find demand, the market will continue to drift lower and lower and lower. Okay? Lower, lower, lower. Okay. Special webinar on Tuesday night. You can look on the site for stuff like that and sign up for it. And or on Friday, we have the live trading webinar thing on Friday. Okay? So I wish everybody a great evening. I want to thank everyone for coming tonight. back on track with the one-on-ones this week, as far as hopefully get everything in this week, and then go from there. Sign up on the website, Larry. Just sign up. Thank you very much, Brian. Yeah, Brian. Yeah, give me a call tomorrow afternoon, Brian. Okay, we'll set that for tomorrow night. So thank you, Ori. Yeah, Larry, look on the site under stuff like that, and there's a whole bunch of stuff. We changed it around a little bit for the last while. So Christine, thank you. Samit, thank you. David, thank you. Dan, I'll see you in about 10 hours. Okay. Will you post the archive of this? The archive will be posted tomorrow. Correct. The archive will be posted tomorrow, but Tuesday and Fridays get posted to subscribers, right? So we'll get a special webinar, a couple of them this week. I think it's the 8th. We may even do 3 this month. I don't know. So there's just 3 Tuesdays. So we get a lot of stuff worked on this week. Okay. So yeah, everyone's information, it's all on the site. LTG, the one you came in at, www. I don't know if you did it, right? Did you? I think you did. So you have to go here and you can look around. LTGtrain.com. Yeah, thank you, Bill, for the prayers. My dad is going for some type of test to see, make sure that it didn't spread. So thank you for that. Okay. So thank you for all the good wishes for him, and thank you for everything. If you want to contact me directly, just contact me directly, and I'll be more than happy to answer your questions. Okay. Thank you, everybody. Have good health and happiness, and we'll hopefully see you all, next Sunday, or hopefully Tuesday and Saturday this week too. Everyone says thank you. Good night, everybody. Thank you, Warren.